Unlock the high returns of the expanding venture capital world right here on the Emerging Managers Podcast.
Well, I'm really excited to have a friend of mine and someone you've known for quite a while too, Tracy, Andrew Romans from 7VC. It's interesting. He approached me several months ago and he goes, Scott, I've known you for decades. We got to figure out a way to work together. And so now we are. So we're actually working on, he's been hosting events around the country, around the world on venture capital, and as have I. And so it seemed a logical conclusion that we work together on events. And so he's been hosting these events for entrepreneurs and also for venture capital firms around the world, London, Dubai, Singapore, around the country. And he's, I think, our first, if not our second, fund of funds VC. So not only does he invest in top venture capital companies with a long history of success, he invests in the venture capital firms that invest in these companies. So he brings a really interesting perspective for the podcast. And he's a 4-time author. And, his latest book is really pretty much becoming the Bible for venture capital funds looking to raise capital.
Yeah. I met him at a mastermind a few years ago. And we, had a few meals together, sat next to each other, started chatting about various things. I mean, his book is fascinating. I don't know if everyone knows this, but I'm like a huge reader. Like I read about a book a day. Wow. And so, people are always like, oh, here's my book, or, here it is. And the next thing they know, I read it. So it does happen. It has to interest me though. I've got too much on my list already, but it's just really fascinating to get these inside views of how venture capitals work, especially from Silicon Valley. And that's, I love the name of his new book or his newer book. It's about a year old, but it's Masters of Raising Venture Capital Inside Secrets from the Silicon Valley, which I think is really interesting because so many of us are outside of it trying to raise capital, and you just don't understand, why does it work the way that it works? So.
And I think it was appropriate to have Andrew on the show because the reality is, as we've talked about before, the genesis of this program is to cast a light on venture capital funds that are lesser known, that are struggling to get the recognition and ultimately raise the capital they need. And now we have someone who successfully done it for, decades in Silicon Valley. He's based in Austin now, but he travels around the world, helping these entrepreneurs and helping these venture capital funds, raise capital.
Well, let's hear from Andrew Romans.
Hello, everybody. This is Scott Kelly, founder, CEO of Black Dog Venture Partners, and your host of the Emerging Managers Podcast. And I'm really excited to introduce Andrew Romans of 7VC Venture Capital. Andrew, welcome to the show.
Scott, great to be here. And I'm waiting for the day they stop calling me an emerging manager. It's been emerging manager forever. I think that might be emerging until the death. And if there's an afterlife, I'll be emerging in heaven.
There you go. Well, before we get into 7VC, share a little bit about your background prior to 7VC and your background prior to venture.
Yeah, sure. So I started off in the telecom industry and the Unix enterprise software industry. And then I started my own startup in the late 90s. And my very first startup, I raised like 48 million pretty fast, and like 25 million from Lucent and vendor financing. And then a bunch of VCs started plowing in. And then we did like a 50 million pre-IPO, and then we IPO'd the company, and then I failed to survive the lockup. So I was like, some like rapper who was made a lot of money and then got like busted by the IRS. And just kidding. I mean, I didn't get busted by the IRS, but my 300 million disappeared on me. Right. And then, after you've you're worth 300 million on paper, it's hard to work at Goldman or Microsoft. So I did more startups, and then thank God I managed to, raise more venture capital, and I sold the company. So I knew a lot of VCs, and then I started the Founders Club, which was a venture capital equity exchange fund where when secondaries were taboo, you could exchange some of your founder stock. So you're worth 100 million on paper, and you can't even take your kids skiing because you've got no money. Right. That you could own 27% and then 3% of the companies now in my thing. And then the other founders come in and we all go out to dinner, and I say, all right, you all own shares in each other. Let's at a minimum introduce each other to the next funding round, since you're backed by the Ivy League of VCs here. And that went on for a long time. And I then converted just a regular vanilla 2 and 20 VC. So we raise money from LPs, we invest in startups, we try to help them as much as possible. And kind of the early LPs and early funds were Founders Club guys that were VC-backed founders. So, behind me is a lot of venture-backed CTOs and blah, 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 blah. So that was a bit of the background on how we got here.
So let's talk about 7BC. First of all, why the name 7BC? Let's start with that.
Yeah, 7BC, I mean, I've always been a really international guy. I went to high school last 2 years in Paris where there were 40 nationalities. And it's not like my buddies are dudes from every country, and same with the girlfriends. It was just fun. And so, I meet someone from Kuala Lumpur. I'm like, yeah, you can invest in my fund, where a lot of other guys that never got out of New Jersey probably don't think it's even going to happen, right? So we end up with LPs from all over the world. Also, I've written a bunch of books, and they've been published in a bunch of languages. And so conference organizers like, hey, I'll pay you to speak at my conference. And I'm like, all right, well, I'll go to Riyadh and maybe meet some family offices while I'm in Riyadh. And next thing you know, you're looking like the big VC from Silicon Valley, giving out your book in Arabic, and you're raising money. So we ended up with LPs from literally 6 continents, and I don't think anyone lives on the 7th one. And so we kind of thought 7BC is like seven continents, like global, international. We have a network that goes beyond 5 white guys from Boston. We're people everywhere. Right. And so we literally have LPs from like Africa, South America, Australia, Asia, Europe, US, Canada, just everywhere. So we kind of thought 7 continents, global, borderless continents, we can take you anywhere. So if it's working there, we can run it at the flagpole to one of the LPs who happens to own and run that country, kind of thing. That's sort of the thing.
Awesome. And talk about your dual strategy. I love the fact that, we've had up to this point only venture fund managers that invested in companies. Mm-hmm. Now you have a dual strategy of investing directly in companies and the fund-to-fund strategy. Break down the thesis, between those two strategies.
Yeah. So, so I went from being the founder to being the VC, and we've just been investing in startups and trying to help them as much as we can. Then I kind of, after, a few decades of this, I kind of lifted my head up and looked around at the whole kind of soccer field and looking straight down at the ball. And I realized what's changed here. And this is what led us to this dual strategy of fund to funds, FOF, and, cherry pick or invest directly, is that when I got started, when I opened our office in New York City about 15, 16 years ago, and I was living in the Valley, but I opened that office and was flying back and forth a lot. We were one of 38 VCs with a real team in New York. There was a blip in the .com when every banker took the tie off. And I jokingly said, after the .com crash, B2B meant back to banking where you belong, and back to consulting where you belong, and leave it to the professionals. But now, if you look at New York, nobody really even knows how many VCs there are. I would guess there's 1,200, and probably 400 are going to fail to raise their next fund or just realize this is the worst job they ever had in their life, and they go back to what they did before. And then, but not to worry, 25% of all YC CEOs that do even fail are going to raise a VC fund coming out of New York. So I think we've had this Cambrian explosion of smaller funds that are founder turned VC, even placement agent, like the guys that used to raise money and I would pay them like a banker. They're now VCs. Lawyers are VCs. Some guy from Google who's never had a startup said, I'm sitting on $1 million. I'll spray and pray Y Combinator investments and then see if I get lucky and then raise a fund. So the number of VCs has increased. And then the original Sand Hill Road VCs that I was raising from, if they had a 50 million check or fund, that's now like a 700, 500, 600 million fund. And the guys who had a 250, 350 million fund, that's now like 1 billion, if not 6 billion. Then it stay private forever. So people don't IPO and they're worth billions. So that means the hedge fund guys like IPO people, Carl Icahn, Fidelity, they're crossing over and investing in privates. So these are the big changes. So what does that mean for strategy? We thought the fund of funds that are typically putting money into the funds, to some extent, do we even need them to have a layer of fees on if you can go direct to like 5 guys that went to Stanford that were the old ones? But right. the returns they're making is really kind of low. If your fund is over $1 billion, you might get a $500K into Facebook seed round and do great on that. But when you invest the other $3.8 billion into growth rounds, you're actually entering at a price point that's not that far from the exit. It's even dangerously above. Like you've got to grow into it. So it's like taking longer to make a small return. And their problem is they can't get the ownership target percentage they seek which is they want to own 30% of every unicorn at the time of exit. So the first time you had $1 billion fund, LP said, how are you ever going to invest in startups and return $1 billion? They said, easy. If I own 25% of 4, boom, voila, there's your money back. If the company in the growth round is only issuing 10% stock, because they don't even need, they're not going to sell more than 10 because they're going to double the size of their spend and double revenue in a year, then they'll buy the growth. That the lead investor is only getting 5%. So it created an opportunity for smaller funds like us to sell part of the preferred shares we have in the best startups into the next funding round when we've gone from like our entry point of 10 or 15 to the company's raising it 500 million, if not a few billion. Right. And then let's invest into the smaller emerging manager funds where the fund size is typically below 150 million, some of them even 5 or 10 million.
Yep.
And they're going to be investing more early, and net of losses, the delta between entry point and exit is huge. And so it's like classic venture. So we're backing kind of this new, and if somebody's coming out of like, Palantir or OpenAI, the Scott Kelly network is unmatchable. I've got my network, but she's got her network too. And it's all OpenAI engineers that are going to spin out with all their checks and do something interesting. So I think it's invest in these funds, maybe be 20% of their LP base. So like 20% of their money is from us. And then we can look at all their deals and from our direct fund, cherry pick the winners and get into the best deals. So we can talk a lot more about it, but that's the basics.
That's a fascinating approach. And I love the fact that you are investing in funds because the genesis of this podcast was, much like you said, is everyone is becoming a venture capital fund, and the reason why we set up this podcast, at the end of last year, there was an article that came out that out of the 3,200 venture capital funds, the vast majority went into 18 to 20 of the monoliths. And, they weren't getting the alpha, they weren't getting, the delta you mentioned. And so it's really, it's encouraging to realize that you have this dual strategy that you can bet on a multitude of horses in a multitude of ways. Let's talk about, you've authored a lot of books. And October you launched Masters of Venture Capital. Maybe share about some of the books you wrote and why you wrote them and what's the rationale and who are you trying to talk to in these books?
Yeah, so the first book was like a baby that just wanted to come out. I was running the Founders Club, and so I had like over 200 portfolio companies, which was part of the challenge of that lifestyle that my Sunday morning was like every slot was overbooked. It's just ridiculous. And we ended up owning like a small percentage of the common shares. But with I had experienced so many founders having, success or failure or how they solved a problem that when I was having those Sunday morning calls with all the CEOs and they're like, what should I do? Should I sell? My board member wants me to sell so we can increase their, points on the board and return money to raise our next fund. I don't want to sell. They're blocking me. What do I do? And I would often be like, well, this other guy did this or she did that. And so you maybe do the same thing. I can put you on the phone with that person. And back then I was trying to be a little more entertaining in meetings and make jokes. And so the combination of like telling stories of what somebody that I knew did and making it entertaining, I was getting like multiple times a day, you should write a book. You should write a book. And then I finally said, well, I'm not going to tell the John Kraft story of how he failed to meet payroll at Pandora 20 times and then still got to an IPO and he founderized people to like with shares to stay and all kinds of stuff. Let him tell the story. So like I would interview him and like, so the first book was like interviews with a lot of real founders like John Kraft at Pandora, like Rick Marini, one of the greatest entrepreneurs of San Francisco. And so you kind of in like 200 pages are collapsing hundreds of years of experience, actually, tens, like a lot of painful, could like kill you lessons from real people, spoon fed to you. So that was like book one, is a bit all encompassing. And that was McGraw-Hill, which I didn't really enjoy, a big publisher with a slow pace. I'm a startup guy. They're like, this is coming out in 3 years in Japanese. And they were even they were demanding huge advances from our Japanese publisher, Nikkei, which came from my Japanese LPs. And so I dumped them. And then on book 2 was Masters of Corporate Venture Capital. So this is like, you're a large corporate, be like Cisco, be a beneficiary of technological change, not a victim of technological change. So right now, this AI wave is kill or be killed. Right. And so every corporate should invest in VC funds, have those VC funds show them anything relevant to their business that's a threat or an opportunity, And then if they want to, they can partner with that startup, maybe even buy 10% of it from their corporate venturing arm that did fund to fund plus cherry pick. And then they can buy the company with M&A. Or they can say we should hire people that know something about, AI and what the salaries should even be. So there's huge benefits to corporates, and it's also a little bit of a fundraising exercise. So we get corporates to invest as LPs in our fund. And then and that even led to, we took our own medicine. We're telling like Telefonica, if you try to invest directly in a startup, you're going to mess it up. Like, do you know, is an uncapped note a good idea? No, it's not. So like, invest in VC funds first, get them to hold your hand and bring you into the room and guide you, don't use your commercial contract lawyer, use one of our lawyers, on Page Mill Road. So that was like book 2. Book 3 was Masters of Blockchain and Crypto. So I kind of interviewed everybody. So I became like an insider of that technology, which is finally attracting entrepreneurs that are not just like out to end up in prison. And then more recently, this last book is Masters of Raising Venture Capital Funding. So I think that, how to raise angel funding, how to recruit, co-founders, board of advisors, all this stuff, and then how to get to VCs and each step in the way. You can do everything right and kill yourself by, self-inflicted wounds right at the end. And so it's a bit of M&A, but it's mostly fundraising, like the title says. And I just think that's incredibly important. So I allowed something like 12 or 14 years to go by, where if something happened in my daily life as an active practicing VC, I would add it to the outline. And you're forced to like throw something off the boat to make room for somebody else on the boat. Right. So I let like years go by before saying I'm going to sit down on an airplane and write this. It's mostly written in the air.
So you've obviously invested in a lot of companies, a lot of funds, and interviewed a lot of companies and a lot of fund managers. Talk about the attributes of a founder that you would invest with and a fund manager that you would invest with.
Okay. Yeah. I mean, they're similar and different. I mean, on the founder, I like a founder that was born to disrupt that industry. So they understand the workings of that industry. They have existing relationships and goodwill with people that almost have guilt to owe them a favor kind of thing, as opposed to sometimes it's also interesting to get someone who's completely outside the industry to disrupt it. Like if you ask a doctor, hey, why don't we use this medical device and do it completely differently? They're like, that's not what they taught me at medical school. That's not the safe, acknowledged thing. I'm like, what were you, a bribed politician by Big Pharma? What's your problem? And that's just like how they think. So sometimes outside the industry could be a new, fresh take on it. But more than not, I like that. I mean, every VC will tell you, I want a founder that'll never quit. So the guy who's already a billionaire, you need to, who's worth hundreds of millions from their last IPO or something. You almost got to be like, is this guy going to get through? Torpedoes hitting him and everything's going wrong. And the husband or the wife is like, why the hell are we not on a boat somewhere between Sardinia and Corsica right now? if we're billionaires, Yep. So a little bit of grit and no plan B sometimes can be good, but I like working with repeat entrepreneurs that, like this idea of universal basic income and abundance of AI is complete crap. You tell a VC with $100 million fund, are you going to stop working? He's like, no, I want $1 billion. He's going to stop working at $1 billion. No, he wants 10 billion. So yeah. I think, this sort of mindset, which is becoming more European, but it's like a workaholic San Francisco thing or New York thing is good. And we just look at a lot of other factors though, when measuring if we want to, how fundable is this, know? So I don't know how deep you want me to get into.
I appreciate all that feedback. So obviously we talked about the entrepreneur side. Obviously you're a fund of funds. There's an ever-growing, list of funds out there, whereas you've got athletes and musicians, launching venture capital funds. So I
pitched by one yesterday.
Yeah. As an event, I forget the name of the band, but they raised $300 million in a venture capital fund. And, their claim to fame was, platinum records prior to that. Talk about from a investor of funds, what attributes in a fund manager do you look towards in making that investment?
Yeah. Well, I guess knowing our dual strategy, one side is to get into funds that have a track record of being in the top 10%. So that's going to knock out almost every fund you've heard of.
Yeah.
Like all the big funds tend to not make these returns. They're a little bit like a Hollywood film slate. Every third movie's a hit,
Yeah.
but the other two suck, And so it's amazing compensation for the guy who's getting 2% times 10 years. So
Sure.
20% of $1 billion. So they're pulling out $200 million on a $1 billion fund. And it's probably bigger than that. They have a new fund every 2 years. So if they only get 20% of 1.2 on $1 billion fund, it's not worth it to be illiquid for so long. You're probably better off in the stock market than investing in a 1.2, X returning fund. But that team, the GP took out 200 million in cash. And he's got some expenses, and then 20% of the 200 million profits. So they get a 40 million payout for losing money to inflation. These are not funds we want to get into. I don't care if it's called Harvard, Stanford, Wharton, Sand Hill Road Fund. We don't really want to be in those. There actually are some big funds that do perform well, and we put tiny checks into them. But it makes it easier for us when we're dealing with a wealth manager in Singapore or Nebraska to say, well, there's some IBM big blue names you've heard of, to be in it. But it's like a very small layer of our capital. We really like the funds that are on like Fund 7 that have been at it since 2005. I call them OG emerging managers. So the OG emerging manager, they probably thought they knew everything about being a VC in 2005. And if you talk to them now, they'll admit that they didn't. And they now think they know everything about it. And they tend to have some kind of flywheel going. And they've had the discipline to keep the fund under 150. They might have an opportunity fund, which we don't want to be on, and which is to invest in their winners, where you're getting closer to the exit and the multiples are smaller.
Right.
And the idea that it's going to exit sooner, I don't believe it. And it's very hard to do a secondary because it hasn't moved up enough. We like the sub 150 million fund that's an OG. When at the same time, the Cambrian explosion had to address, the Palantir woman turning VC with her network, is we're saying we are willing to be up to 20% of your fund, but we want to be in the final close. So we want you to run around and raise money, and we'll be in the final close if it's up with, a positive TVPI. TVPI is total value to paid in, and that measures if you invested $1 million into the startup at a $10 million valuation, you own like 10%. And then they raise at an $80 million valuation, you're up. I mean, for bad math, you're up 8x. It's actually not true, but if you're up 8x, and they do a couple of those, some of them go to zero. It might be that they've been raising for 24, 36 months, and we've been tracking them, and they've been coming to our events, and they met you, they met me. You're telling me what you think, and we get to know them. We will say, all right, the final close is coming, and the fund is up on paper 2x. Yep. So if they maybe only raised 8 million, that's a 2 million check from us. We put in 2 million. And at the moment that we put in the 2 million, our 2 million is worth 4 million. Right. So when I'm doing the financial statement to my LP from Africa or wherever, I'm saying, dude, good news. We invested in it. The minute we invested, it was worth 2 million, went to 4 million. Now, we also look at every company in their portfolio saying, do we want to invest in it from our direct fund? Right. And do we think these guys are fundable? And we might see this guy's not going to get funded. It's going to go to zero, or they'll be lucky to get anything out. But these other ones more than make up for it. This one's on a tear. There might be one company in the portfolio that we want to own. We might not even love or even like the GP running the fund. And yet I just see one asset in there that I have to have. And we're going to get into it by being an LP in their fund that bought into that at 8 million or 3 million, something crazy. Right. And then we're begging for an intro to get in direct or the back door. The other thing is we can, if I see a VC with high TVPI, so unrealized returns, it's up on paper, and low DPI, which is distributions, where they've returned cash, I say, I just got in your last fund at the very end. When are you going to raise the next fund? And they're like, I'm exhausted. I need a vacation, but I'm going to have to go do it immediately because I'm out of money. Right. And so I'm like, all right, how much money have you returned from the other funds? They're like, almost nothing. It's only been 3 years, or it's been a slow IPO market. And we say, all right, if you can return your fund 1x, it'll be much easier to get those same people to re-up in your next fund, and even attract new investors to invest. If you say, I've returned more money to my investors than 90% of all the other VCs in the Valley or the world. Okay. It'll make it much easier. So we step in with our direct investing fund and say, what happens if we buy 10% of the shares that you have in your top 5 startups? That'll enable you to return 50% of the fund. Okay, let's make it 20%. But we're going to be looking for some kind of discount to the last round.
Right.
And if they don't like that, we say, no problem. Go find someone to pay you full value. That's great.
Right.
It's not so easy to find a secondary buyer for these small slugs. Most secondary guys just don't get out of bed for anything under 100 million.
Sure.
Whereas for us, we always like looking at a startup. We'll do it. Right. So we're cherry. That's an example of the cherry picking, and that's an example of this fund has high TVPI and low DPI. That immediately, our spider senses start tingling when we see that.
Right.
Yeah.
So let's talk to potential LPs in 7VC. So maybe you could share some success stories from previous investments or some of the portcos that are doing some great things now.
Yeah. Well, the most recent exit is a fun one, and I wish they could all be superhumans. We met Raul. I was a user of Reportive, so I knew his previous company, and I loved it. And LinkedIn bought it. And then one of our portfolio companies, the founders were actually cousins of Raul, all San Francisco stuff. And they said to Raul, let these guys into your seed round. They've been enormously helpful, and we just like them a lot. And so all the investors that invested in Reportive wanted to invest in Superhuman. So he was kind of oversubscribed for his very first outside capital round. And it was focused on optimizing email. And I send a lot of emails and I receive a lot of emails. I'm making intros for portfolio companies for the next round and all this. And so I make sure I look at every email productivity I've ever heard of. But this one looked like doing it the right way. And he seemed like the right guy to do it. And so when he came into my office, I committed to fund their first outside capital round before he incorporated and before he recruited the first employee. But he had an idea who he was going to go to, but he wanted to recruit him saying, I already have the money. So he's like a smart senior co-founder. Like, not everyone can be a Raul Vora, but he pulled it off amazingly. I knew he would have no problem raising more money. I knew he would have no problem taking the same tech that he had made with the same team to make this work. So he kind of had all the pieces in place for a pre-revenue, pre-launch, pre-product investment. We invested at 8 million. And then I don't know if I can say all this. I guess I can. It's over now. At 8 million, then like a year later, we were in the next round at 11 million. And then we were in again a year later at 41 million. And we introduced him to like first round capital, Josh Koppelman, they led a round. Then we introduced him to Andreessen Horowitz, they led a round. And at that point, like Andreessen's making the intros to like Tiger Global and institutional IVP. And they raised a big round. A lot of it was secondary, but they raised 75 million in their Series C in August of 2021. And I'm not legally allowed to disclose what it went for, but the company was acquired by Grammarly for a good chunk more. I don't know if that's legal for me to say, but more than the 825 million valuation of August 2021. So coming in at 8, coming in at 11, coming in at 41, and exiting it at above 825. That's venture capital the way it's supposed to be.
Right.
Now, if you had invested in that last round, your multiple, it's not the greatest, but I guess, in on August and out in 2025, that's 4 years. I don't know.
Right. What things are piquing your interest now?
I mean, I'm not going to differentiate myself by saying it, but I just think that real artificial intelligence is for many years we've been saying, and it's documented because you write a book and you're not going to go back and edit. I've been saying it for like decades. Right. Software companies that are automating human workflows that then reimagine the workflow. So you have like a couple of humans are like taking clinical trial data and making reports, and they're all PhDs with huge salaries, then begin to automatically, programmatically get the data from the clinic as it's happening and make a continuous report that you can just push a button at any minute and get a report. that's, using the brains of these super smart PhDs and like makes it, and then is programmatically disclosing the side effects that are, written on the side of that pill box or whatever, that this causes hair loss, it causes weight gain and bloating or whatever. So it's like, we're not huge in healthcare, but like that's an example of reimagining the workflow. Yeah. And you're not going to fire this team of like 30 PhDs that live in Basel, Switzerland. You're going to repurpose them into something else. And, I don't believe AI decreases jobs in any way. That's like saying, now that I've got a $10 billion fund, I'm going to stop working. Now that freak wants its $100 billion fund.
A continual process.
And I don't think I'm that way, but I like the small fund and the discipline of the art of the game. But so I would say that's a long way of saying AI, and that I also kind of like fell in love with. I was helping the guys at Palantir do secondaries, like every 6 months. For a brief period of time, I was under a BD doing that. It was an offshoot of the Founders Club. We were dealing with. When there was no secondaries, there was us. And then as secondaries started to happen, and I'm like losing people they sell their private shares for cash instead of joining the club. I was like, I can get you a better deal. You're getting taken advantage of by your VC, buying your shares at a 30% discount to the last price round, saying these are common shares under the liquidation stack of VCs get their money out first. I'll get someone to pay more than the last preferred of the preferred, and your common will sell for more than that. So I was working with Palantir closely. I thought, man, this is the answer. This is the holy grail to everything. That we need a Palantir for every single idiosyncratic industry. So the way this is done, that we should be doing the same basic AI stuff of if this, then that, pattern slam. Right. And so I got very excited about kind of Palantir for everything, if you know how Palantir works. And I think it's, with the OpenAI, we all had the aha moment of, write a love letter that raps, that rhymes and raps and do it in Japanese, whatever. That they were like, holy shit. So that being applied to everything, I think is just like, it's now an arms race and kill or be killed situation of AI native companies are destroying incumbents or forcing the incumbent to buy them.
Absolutely. Yeah, it's every day in the news that you hear just that exactly. So for potential LPs that want to invest in 7BC and wealth managers that represent those that want to invest in venture, why your fund and why right now?
Well, I certainly don't want to violate the ban on general solicitation and be saying that we're soliciting anyone to sell securities and shares in a VC fund. But we do have a lot of in-person events and opportunities to meet with people or get to know people and develop relationships over Zoom and in person, so that when it's suitable at the right time, they can come. You're saying why us? Well, I think that somebody told me at an event that we hosted in Singapore just in May. He said, I don't like investing in fund of funds because it's a layer of fees on top of a layer of fees. And I can just directly invest in these guys myself, the VCs that were in the room. And I said, well, do you know any VCs in Utah? He's like, no. Do you know any VCs in New York? He's like, I know some. I'm like, name 5 VCs in New York with a fund under 150 million.
Right.
And if you look through all their portfolio companies, it's just like, I just think that like every big endowment should create a business unit to do the work. They really should.
Agreed.
And I just don't know if they're going to do it or they are doing it. And trust me, I've been around for forever trying to raise money from the fund of funds that I've heard of. And the fund of funds were either like too viciously invest in cherry pick that we're not investing like pre-revenue enough for them to come in when we want to come in, or and they didn't have a lot of money, or they're like, we don't want to invest in anything under 250 million. Our minimum check is 25 million. I want to be 10%. I'm not going to be more than 10%. So they've almost like forced themselves into the low margin sector of the market, which is stay private forever and invest at a 750 million pre and get out at something north of 825, which is what happened on the last round of Superhuman, right? It was a 750 pre and a 75 million of primary for that. Right. So I would say that there's going to be others that look at what we're doing and say, why don't we try to do that? I feel like we knew the founder before the founder turned VC.
Right.
So it's like when COVID happened and people said, I heard a lot of Sandhill Road guys going, I just can't invest in a startup over Zoom. I'm like, well, first of all, what are you going to smell her hair like a creep? I mean, what is this? We always had New York and Silicon Valley. So one of us was always investing over Zoom.
Sure.
But I also said, what kind of VC are you that you've never met this founder before? This is her third startup, you know?
Right.
So I would say that just being out there and ecosystem builder, you know, much like you, Scott, of all the events that you do, that, you know, you kind of help the other person first and see what good karma comes back eventually.
Sure.
That we know all these people going back for so long that, you know, we have a little bit of a sense of which one to back.
Right.
Not to mention doing the math on everything that's happening inside of these funds. Well,
and you wrote the book on it. So anything else you want to share? Some final thoughts you want to share with our listeners today?
Yeah, I guess so. One thing that we are committed to doing is we used to go to a lot of family office events or VC meet LP events. And we found that, you know, it felt like ladies' night where the women drink for free and the guys pay. And it was like, feels like a lot of guys in here. Or if that person's not paying, they should be paying, because I don't believe they're allocating, and I figured out that they're not. So there was a lot of kind of fake people that say that they're a family office to get the free suite at the Ritz-Carlton that we were paying for. Yeah. Or they say they're a family office at the event, and the next week they're like, actually pay me $80,000 retainer. Yep. And I'm weaseling my way by lying that I'm an allocator to 5 more of these events in the next 6 weeks. Sure. And so we thought, why don't we just do our own events? Sure. Let's do our own events, and we'll be like Y Combinator and say, another key thing to know is that for most of the other events, the only criteria for stage time is that someone paid them money. If you say like, I'm allocated with the Jeffrey Epstein, you know, fund, they're like, sure, whatever, pay me the 50 grand and you're on stage. And they don't care about anything else. We thought, as the FOF and looking to cherry pick and looking to develop relationships with VCs to invest in our deals, we invest in their deals and all that, we'll have merit based. So they're selected based on performance and other, objective and subjective metrics. And so we have really top decile funds presenting, and then we fill the room with like another 80 VCs or 50 VCs that are out there. And then we vet. Like right before this call, I was researching who's applied for the free ticket. And, you know, I've been issuing 1 acceptance for every 10. Yeah. Because people say they're an allocator. I'm like, you don't look like an allocator to me, but I'm happy to, you know, tell me about this if it's true. Happy to get on the phone, blah, blah, blah. So it's called the Global VC Demo Day event circuit. And we're doing it like twice a year in Silicon Valley, twice a year in New York. We're doing 2 events in Austin. We're doing 1 in Miami. We're doing an event just for founders and VCs in DC coming up in September. And then we just did London, which we'll do once a year. Dubai once a year to get all the GCC people together. And Singapore, which is like an amazing place. You know, we probably should be doing more, but there's only so much travel you can do. So this enables us to kind of keep a lot of relationships going. And so we encourage, you know, primarily we're looking for VCs and allocator LPs, you know, to come together. But, you know, there's a lot of other important people that are the glue that keep the system together that we like working with, that are super important. You know, but we want to keep a high density of allocating LPs and VCs. So that's an event. Maybe we put a link in the show notes if it's relevant to anybody.
We definitely will. And with that, where can they learn more about 7BC, yourself, and your events?
Yeah. Well, I'm easy to find on the internet and LinkedIn. I'm Andrew Romans, and our website is 7bc.vc. And with your network, with all these emerging managers that you got, people that are interested in this, my email address is andrew@7bc.vc. So andrew@7bc.vc.
Awesome. Andrew, thanks for being on the show today. For all you listening in, I encourage you to follow up with Andrew. You know, go through his books, listen to what he's talking about. He knows what he's talking about because, like I said before, he wrote the book on venture capital. So, Andrew, thank you for being on the show today.
Thank you, Scott. So great to see you, and see you soon in person. I think we're going to meet up in September.
Absolutely. Take care, guys.
Bye for now, buddy.
You know, Scott, that fund to fund that you referred to at the beginning and then Andrew was talking about, it's like, it is unusual.
It is, but I think the reality is, you know, smart investors realize they can get diversification with individual investments, or they can get diversification through a series of different funds. Like individuals, they can invest in individual stocks, or they can invest in a number of different mutual funds, which in turn own hundreds of stocks. And so Andrew has taken this approach of backing these top venture capital funds and with his capital. And so the reality is, what it does is that he can't be, and no fund manager, regardless of what they say, can be a specialist or an expert in every sector, every industry, every region. And this provides an opportunity for him to take his expertise in investing in very fast growing individual companies and applying that same ability, that same skill set to invest in really good fund managers doing the same.
Well, and I think that's probably why we didn't hear of it here, because when you're an emerging fund manager, you're usually focused on the sector you know best. So that's why it hasn't come up in our podcast so far.
And you're finding, many of the folks on our podcast have got their investment into their funds from fund to funds. Mm-hmm. And so I think it provides a really interesting perspective. And, I think obviously for the emerging managers who listen to this podcast, they're going to want to learn more about what Andrew's doing and, probably get in contact with him.
So you were talking some more about the events you guys are going to be doing together. And I'm really excited about that, because I think there's a real synergy to your audiences and to the way that what you can bring to each other. Yep. He was doing some of these global VC demo days, and yep. Is that going to continue? Is that the kind?
Yeah, he's been doing them for years, and he has. If you go to his website, there's access to all the events he's doing. We're going to be partnering together on several of his events in New York, San Francisco, DC. Later next year, it'll be Singapore, Dubai, London. So he's been in the VC event business probably as long as I have. So it just seemed to make sense that 1 + 1 can at least equal 2.5. So.
I think it definitely will. I look forward to seeing what you both do. I think that the perspectives that you both bring, because, I think you have I'm going to say a little more of the experience on the nitty gritty founder side. Mm-hmm. And he has more of the really big fund side. So you're kind of broadening that pool that the two of you have just out for both of you. And I think that's going to be fascinating.
No, I think the reality is between the two of us, we can pretty much spawn between pre-seed all the way up to an exit. And I think the reality is it provides a really interesting opportunity. And for me, it's a great opportunity to get the Emerging Managers podcast into more of the folks that we want to talk to.
Even more funds,
Exactly.
even more managers. I look forward to it. Well, Scott, this is my last episode being your sidekick.
I know.
Doesn't mean I won't pop in. Doesn't mean I won't comment on social, because I definitely will. I will. But you have just done such a fantastic job on getting these all that I can step away now and do some other things that I'm working on, because I got to I got to put my founder hat back on and get some work going again. But sure. I will touch.
Well, let's do this. Well, why don't we do this? Why don't you share with the audience what you have going on?
That's so sweet. I appreciate that. Yeah, absolutely. So I have been working on this podcast production company that produces this podcast right here, the Emerging Managers Podcast. And we have been working on that since 2017. 2017. Mm-hmm. And early in 2018, we added AI. So we added AI way before anyone else did. And what we've now realized, I would say 2 years ago, we realized we had hit on an actual creation process for a large language model, a model creation system. And so we have the basis for that. And we just decided in this past year to spin it off. And so the spinoff is happening. And I will be solely going over to that new company and working on the finality of our model. And you and I both know in retail and in e-commerce, it's called last mile delivery. That's what our large language model delivers. It delivers that last mile delivery, there are some people out there who say, oh yeah, our transcription process, our speech to text, all of this is correct. And everything you do in AI is based on that.
Right.
And it's not. It's about 70% correct, no matter what anyone says. That theirs is 90, 95, I've even heard. It's not true. And so it's about 70% correct. And that last 30% is huge. They're like, oh, it's good enough for the AI to learn. but that last 30% means your brand is spelled wrong. My name is spelled wrong. It means the important stuff is missing. It means it didn't get delivered to your doorstep. And that's what our model can provide because we've been doing it so long. We transcribed by human and by AI 50,000 episodes to train our original model. And now we've gone even way beyond that in the last 3 years. So it's pretty cool. I'm really excited about it.
Well, we'll probably be interviewing you sometime soon, Tracy. But
well, yeah, I mean, we're not raising or anything, so not right now. but who knows? We might be.
You never know. Well, thanks for being my training wheels over the last few months, and hopefully, I continue to ride the bike straight.
Oh, I know you will. And I'll check in on all of you, and you all can check in with me anywhere on social media. Check in with Scott. And do not forget to go to the blog post for these episodes, emergingmanagerspodcast.com, because that is the most comprehensive place for you to get everything you need on this show.
Join Scott Kelly, Tracy Hazard, and their high-performing capital fund manager guests next week on the Emerging Managers Podcast. Don't miss our upcoming virtual and live VC Fast Pitch and podcast events. For more details, background on our guests, or an application to be our next guest, visit emergingmanagerspodcast.com. Don't miss out on shaping the future of venture capital and entrepreneurship with us by joining our robust community of innovators and investors today.